Okay. So, one quick thing before we start. This is the only like product pitch I'm going to give to you. Um, all the data that we're going to be using for the data deep dive is available in Wheelhouse. It is actually most of it's going to be is freely available to you. So the market reports that I have available are available to anyone who just makes a free account with Wheelhouse. And you can look at any market report basically in the world that we service. In addition to that, I'll often talk about pace and kind of like watching your own pace and seeing how you've done according to historicals, kind of in a way like a key data light. We do have a full performance insight suite, and that is also free for anyone who signs up and links their account. So if you do need some extra data, or you want some insights, or even just some training on how to use our insights, let us know. We're happy to help you get set up and help you be as successful as you can. So anyway, um, I'll hop over to this market report, but before I start diving in, I did want to ask the question of just kind of like, how are things going for you right now? How do you think the summer has been? What are you kind of expecting for the fall? I know I've been doing this with a lot of markets, and my general feeling around the country is that people were panicking pretty hard in the spring, right? But that has leveled out a little bit. It doesn't necessarily mean that everything is like better or doing better, but definitely the sentiment has leveled out. And I think people are more accepting of just that it's a competitive year in a lot of places and that they have to make changes. How are things going for you guys?
I'd say that's accurate. I think we're clearly dealing with a window for booking that has gotten a lot shorter. At least that's what I've seen. But as far as year over year, I think we've had a pretty comparable summer, which is a good thing.
That's
And
good.
looking for a strong second half of the year.
Um, awesome. Thank you. Anyone else? So booking window a lot shorter, maybe a little bit of kind of acceptance that it's, not panicking anymore. All right. Um, so one just follow up on that, Richard, is with the booking window being a lot shorter, does that have you changed the way you price further out too?
Um, it's just a matter of kind of keeping a close eye. I mean, we're blessed to have our own revenue manager that's keeping a close eye on things, and kind of just seeing what the market is showing us. We are in a couple different markets, but in this particular one, in this situation, it's a matter of just without overreacting too far out, just kind of keeping an eye and making sure that we're trying to be as proactive as possible to stay within the average daily rates that the competition is at, and kind of just keeping a close eye on it without making any knee-jerk reaction, especially too far out to the year.
That makes sense. I have been, I still notice a trend across a lot of markets, and we'll see, I'll pull up some of the average rates here and see how things kind of look in this market. Um, but the some of the largest organizations with like really big revenue management teams or just a lot of portfolio have tended to perform decently. And this is actually true for a lot of professionals. A lot of professionals are performing pretty decently, even though the markets are under pressure. From an occupancy perspective. Like, so they're taking more of the market share. And it tends to be that they are taking a more conservative approach, looking a little further out, trying to build a base of business. Doesn't mean they're giving away the farm, but they're definitely looking further out. And sometimes when you look at these markets, and we'll see if we can see it here, you can almost see a trend where you can tell that a lot of people don't have the capability or aren't yet looking out past a certain point, right? And when you're talking in like the professional revenue management circles, a lot of folks, will talk about looking out almost a whole season in advance and trying to get ahead of that so that there's a lot more stability in their revenue rather than trying to like go for the higher rate. I do still see a lot of premiums And so the reason I bring this up is I'm constantly wondering as a revenue manager, how much of the booking window being shorter is the consumer, like changing their behavior, and how much of it is actually that pricing from supply is not very well optimized to the consumer at certain points. Like, is the consumer waiting to book at a shorter time period, or are they just waiting for the price to be in their budget, right? I don't know the answer to that question. Everyone kind of has to have their own idea, and it's probably a little bit of both. We probably have consumers who are booking shorter just because you plan shorter, but also things might be a little too expensive further out. Um, so from a supply perspective, this is a question I have for you guys. I know that like Sevier County and Gatlinburg has had a lot of, and Pigeon Forge in these areas have had a lot of supply growth over the last few years. As you can see, this is a very large wheelhouse market. 25,000 listings is probably puts us in one of the larger groupings that we have when we're looking at a broader market. What is your guys' opinion on the supply situation right now in the market? Is it continuing to grow? Does it seem a little bit too much, or do you think there's more on the way?
I think there's definitely more on the way. I think the market is very oversaturated. Um, it's definitely an opportunity. I think folks that have owned their cabin for a really long time that kind of paid a realistic amount for it or have their cabin paid for are comfortable with lower rates, kind of going back to how we were in 2019. And then the newer ones, unless you just have a very modern luxury cabin, I think it's the people in between that are kind of stuck. Like the ones that aren't very updated, but still paid a premium for it that are expecting top dollar.
That's really tough. Um, Corey, did I see you come off mute too?
Yeah, I agree with that totally. Yeah, we're in a very saturated market, and growth just continues to go. I mean, we've got a lot of new houses coming on, and it is the folks that bought their homes in like 2021, 22, and even the first part of 23 that paid premium prices that are just like, oh, I was getting this in 2022, and they're not fully understanding. Yeah, but that was not true data. I mean, you kind of have to go back to 2019 if you want to kind of see how our area works. But now we've got, you know, not as many folks coming here, of course, and we've got a whole lot more properties to try to rent. I think, if I'm not mistaken, it's probably about a 25 to 30% growth rate since 2016. So that's a lot more properties in the area.
That is a huge growth rate. And unfortunately, it's very helpful to have market data to kind of talk about what's going on for these owners, but at some point they may just have to reject it because their solution can't be to be underwater in their minds, right? So a very tough situation to deal with from a revenue management perspective and also from a owner management perspective. Um, is there anything are is the main approach just like update your unit or, just try to grid it out?
For our strategy, of course, when we go and talk to potential new homeowners, is we just tell them the truth. You know, this is kind of what you're expecting. Use key data, use Wheelhouse, different things, and show them this is kind of what you're looking at. And they'll be, well, they told me I'd make this. I'm like, well, unfortunately, that's probably not going to happen. And I'd rather on the front end tell you the truth. So that's kind of our point. But yeah, we have like a lot of the older properties are doing remodels to bring their properties up to standard. And they have to, or they're just going to be left out.
Yeah, that's really good. When I look at so there's a few other markets that come to mind. Um, other than, Sevier County that have had really, really large listing growth. Obviously, down by the Panhandle and Destin, really massive listing growth. Orlando, substantial listing growth. Interestingly, Phoenix, that's more of a regulation thing. Like there is very open regulation for what we do. Like there is regulation, but it's open. So there's been lots and lots of growth. Those markets are all this year starting to level out or turn the other direction just a little bit. So I was telling people when we were doing market data stuff that, 2 years ago that I thought some of the supply problems would it would take a few years to level out, and it's just starting to turn that way in a lot of markets. I would expect that you'll start to see that here as well, but the thing is, it still takes a few years for those supply imbalances to kind of balance out. The other thing too is, generally speaking, aggregate demand, even in these markets that are overbuilt, is still increasing. So it really is a mismatch between how much growth is happening and how many consumers are coming. It's not so much that demand has dropped. There's very few markets where like total demand has actually dropped still, even with some of the shakeups this year that have been happening economically. There are a few that has happened, but generally speaking, demand is still growing. It's just supply has outgrown demand, and has done that for a few years in a row now. Okay, well, let's hop into some market data. As I'm going through something, feel free to just step in and either ask a question or give an experience or talk to me about what you're kind of seeing. We're going to hop over here to, so just where I am, in case you do want to access this data on your own, I'm on a market report. You can search for any market in the country here. I've got Sevierville pulled up, and you can see that this is a pretty broad area, right? We're looking at Gatlinburg, Pigeon Forge, up into the Great Smoky Mountains. Most of the listings are going to be situated here. So you do see that we kind of go up into this area, but honestly, it's a fraction of the listings. It's less than 400 listings in this entire area compared to most of where everything is down here. And I'm going to hop over here to the trends section. I really like this trends section for getting just a basic idea of what's going on. The reason being, it shows me a lot of data. It shows me year over year, it shows me month over month, so you can see quite a lot at once. I do like to start with occupancy. I think occupancy is always just a good surrogate for demand, right? It tells you how much people are getting booked. Generally speaking, if occupancy is up, things are probably pretty good. If occupancy is down, things are probably more difficult. I also think that adjusted occupancy is a great kind of like a graph like this is good for owners, right? You're trying to communicate to owners what's going on in the market so that you can justify either decisions that you're making on your revenue management or like asking the owners to be able to make certain decisions, like drop their rates or drop their minimums and stuff like this. A lot of owners aren't in our industry. They don't understand all the KPIs. So occupancy is usually something that they can understand, right? First thing to note here is when we look at Q1, little attrition across the market. Now we are looking at everything altogether. I'll filter this down in a few ways in a minute, but just kind of at the top level, that's why overall occupancies are fairly low when we look at the market at large, which includes all of like the hosts and all of the kind of like non-optimized properties. Something I have noticed when looking at this with other data is professionals tend to be doing quite a bit better than the market at large. Right? I think that makes sense, probably makes sense to you guys, especially if you're using key data and you're just looking at direct data. You tend to see a slightly different story than when you look at the market at large. And often, in my opinion, that story tends to be the market is under a lot more pressure, but the professionals have found a way to maintain year over year performance within that environment of the market being under pressure. So they're doing it by taking market share from people who are less optimized. Potentially a good opportunity for people who, for owner growth eventually, particularly if there's like, rental by owner or things like that, or small owners that maybe aren't performing very well. But that tends to be a consistent trend. Are any of you guys using key data here? Do you see that, like, in general, how is the key data direct data performing? Is it kind of close to year over year?
Yes.
Perfect. Yeah. Okay. I've looked at a lot of these markets with folks, so the trends tend to be somewhat similar, Okay. So going into this, we start to see attrition in about February, a little bit in January, but kind of low season, still low season in February, but that attrition kind of follows us through the whole beginning of the year. Now, that's another trend that has been kind of national. Sevierville, Gatlinburg had a little bit more attrition earlier in the year. Most markets, particularly along the south and southeast, had a little bit stronger January. And it wasn't until February or March that they started to see that attrition. Now, Stronger January doesn't mean much in a lot of these markets because it's a low season. So most people are like, it's not a big deal. Like a few percentage points on a low season isn't a big deal. Most people don't experience it, so they wouldn't have noticed. But by the time we hit March, we start to see attrition across most Southeast uh, and Southern markets. Now, I think that's a really interesting point here because if we go into the history and we think the reason I'm talking about the historical stuff is so we can kind of think about what to do at the tail end of the year. But one of the things that struck me as most interesting is I don't know if any of you guys went to DARM last year or I guess Verma and sat in some of the data sessions with like key data. But I recall specifically at DARM in December of 2024 that pacing was really good for almost all of 2025, that everything was pacing ahead as of Q4. January was performing well by January. And then it all kind of flipped in February. So it seemed like things started to stall for future months. And then suddenly everything started pacing behind across the board. That's where everyone started to panic, right? Suddenly you went from like things being really well to things being pretty poor. Now, one of the things that struck my eye when key data was showing that most regions were pacing ahead for 2025 in 2024 was kind of an interesting tidbit that they were pacing ahead in occupancy, but they were doing so at a lower ADR. People took that a little different. I took it as, okay, there is pressure. People need to be more conservative, right? Because what's happening is people are they're buying more. So there's plenty of people willing to buy, but they're buying at a lower rate, right? Some people took it as it's just going to be better, kind of risky. But what ended up happening is we see this attrition starting to occur kind of across the board. Now, how do you guys like just briefly, do you consider Easter like a pretty decent time for you guys generally?
I think it really depends year to year how it falls within the spring. It can be, but I think it's a little bit more metro of people coming to visit their relatives. So we see that in other markets that we're in.
Yeah. That makes sense. I mean, this loss in March is pretty substantial and pretty substantial for what's probably pretty much a high season month. Now, some of that may be Easter because you don't see the same gap in April. You don't see it made up for, but you don't see the gap continuing. And that's something we actually saw a lot of places. So Easter may have driven some interesting occupancy. We can actually just kind of see this if we go into the daily level. I'm gonna zoom in here. So when we look at this, green is last year, and red is this year. So really, Easter was about here. Easter didn't drive any extra occupancy this April. It's just this weekend before Easter, like in the beginning of April, that was really strong this year. And interestingly here, this trend is kind of interesting. Like you can see there's a bunch of gaps in March, right? These weekends just did not drive the same occupancy at the market level. The length of stay was shorter here and here. Those only got weekend stays. And it seemed to stretch out to here. So this seemed to have pretty even demand, whereas last year it really spiked. So part of that could be I'm not exactly sure what all the demand trends driving performance in March are. Some of it could be just the macro stuff that was going on, people not paying as much money, obviously taking shorter trips. That's a big one. Is we talk about short booking window, but shorter length of stay is a major piece that pretty much most markets across the Southeast are experiencing. But also kind of a diluted demand, right? The demand hit on more days across the 5 or 6 week period, but it never hit as strong on any given day or any given week, right? Okay. So kind of moving into the rest of the year, right? We see that attrition continue all the way into June. And the question is, where are we in the future? So we're almost done with the month. I did pull up the pacing information for July, August, September, and October just to kind of see where we were at the market level. And July is pretty close. the market's about within 1%. So it's just within like roughly 1% of where it was last year, which is pretty good, right? Now there's still a little bit to go. We got about a week left, but that pace is about on track. It deviates a little bit as we get into the fall, and this goes into that shorter booking window kind of conversation that you folks have said already. We're within 2% in August, but just slightly down. We were at about 24% around this time last year. In September, September is actually the one with the biggest deviation. It's at about -5%. It was at 13% last year. But again, not a ton here. And there's kind of this odd thing where this October is pretty strong season, but we have this dip here in between. And that's pretty consistent. I mean, August is not generally a strong month unless you're in the Pacific Northwest or kind of the West Coast where schools start so much later. August tends to die down as people go back to school. September tends to be pretty weak. And then you guys have a high season again in October. So we would expect the booking windows to be a little shorter here, but that's something to keep in mind is that the market is down a little bit in September, and we're getting a little bit of a mixed message, right? Things have been down. July seems to be kind of on track. August seems to be pretty on track. September seems to be down a little bit. And then October's about on track. It's within 1%. It was about 8% last year, 8.5. I'm looking at ranges, so they're kind of rough. So within a percent means about on pace. As you guys look forward into the fall in particular, how is your guys' pacing going? Are you maintaining your pace? Are you doing so at a lower rate or a higher rate position? Are you being more conservative because there's been a lot of attrition in the occupancy position this year?
Well, for us, it's like our August is really doing extremely well compared to last year. Our July did good, June did great. October is about the same as it was last year, which is kind of surprising for me. I figured it might be a little bit better. And November and December are doing real well. But right now, October is the month for us that's kind of like, we're not down for it as far as pacing goes, but it's just not what I thought it would be when I planned everything out. We're still ahead, just not as much.
Yeah. Is your ADR higher or lower for
Oh
October?
gosh, no. ADR, I think everybody's ADR is probably dipped. I can't see anybody saying their ADR is higher than it was last year. And you've got so many STRs in the area doing it, and then they start to panic. They drop their stuff on all the channel partners out there with Airbnb and your independent folks. They're the ones that panic first, and they just kind of start driving the prices down. So we're still not in the race to the bottom for us, like a lot of folks are. So yeah, it's down. It's not down totally as much as I thought it might be, but yeah, it's still down. Occupancy's been pretty consistent though.
That's good. I mean, in an environment under pressure, maintaining occupancy, I think is the most important thing, right? Like optimizing ADR almost always comes after optimizing occupancy because, occupancy is worth more, right? Like an unoccupied day is worth nothing. And there's, I guess you can't multiply something by 0 and get any kind of number, but it's like, so it's infinitely more valuable to have any value there, right? So the reason I do ask about the ADR side is I do talk to people whose ADR is up, but their occupancy is down, which generally is worse for them. And so it's a way for me to kind of understand where their rate position is relative to kind of what they were doing last year. But looking that far out, knowing that your ADR position might be a little down, that could be a shift in what kinds of properties are booking, is pretty interesting. Now, we do see in the market data, even though October is kind of just like stable to last year, it is booking quite a bit relative to September. So even though it's a full month further, it's within a percent of the occupancy on the books. So looking at kind of October, you can see that it is still on track to be a higher season. It is booking quite a bit because when we look at these other months, there's big drop-offs. I mean, even between July and August, there's, 25% occupancy difference between one month. But then when we look even further out, where the booking window is further out, September and October are nearly neck and neck. October being the further month, also being the one that people expect to have a little bit more occupancy on the books for. Anyone else want to share kind of what they're seeing from a pace perspective?
It's kind of like for us, it's just really hard to tell, I would say. I mean, I could say probably agree that August seems to be doing okay. But also it's like pacing against what? Like pacing against last year. Seems like for some months we've been like, oh yeah, we're going to pace really, really well. And then the timelines were just a lot different of like when we got all the occupancy, we got all the bookings, and we either went on a few weeks, we're like, oh, we're going to be really behind. And then it kind of all came at once. I'm like, okay, we caught up a little bit, and it just behaved a lot differently than the past couple of years. And so I think, going forward, it's kind of hard to tell. Like, I don't know how overly accurate what we believe our pacing to be is. And so we're just trying to do our best with what we can project out and price out, but not get maybe too greedy.
Totally. Yeah, it is tough. I actually think this is one of the more difficult markets in the country in terms of consistency. I feel like it's a market that has been very inconsistent over like really since COVID, like more inconsistent from a seasonality perspective than other markets, right? And booking window perspective. It kind of shifts around, it feels like to me. When I say pacing, I mostly mean like, how is your occupancy pacing compared to last year for given time periods? And then where is your rate position or ADR compared to last year? Because the kind of story you're telling is like, hey, am I pacing and occupancy the same? And am I doing so at a higher rate than I was averaging last year or at a lower rate, right? And then you can also start to make decisions there, right? If I'm looking at this history of kind of attrition, maybe up until July. July seems to be kind of on pace. It seems to be turning around. You kind of ask yourself, well, like, hey, if it seems like the market's falling a little short, and maybe I have a history falling a little short, maybe I want to pace ahead. And in order to do that, I might have to drop my rate a little bit, but kind of finding where that relationship is. If I want to be a little bit ahead of last year, maybe, 10% ahead or 5%, and my rate is also higher, do I have room to kind of bring my rate down to get to that pacing goal? My hunch here is that large organizations, and Corey kind of said this a little bit, they're trying to at least stay on pace or pace a little bit ahead, and they're doing so by allowing their ADR to be lower than it is now, but probably not necessarily lower than the average ADR was last year when it finished, when you combine all the last minute stuff and the future stuff, right? Because as we know, people tend to keep their rate a little higher, then it drops as we get closer. That average is usually lower than what people are posting in advance. And let's take a look at the asking rates, because I think you'll see that in the market quite a bit. It tends to be a trend that's pretty consistent in most markets here, but asking rates, I think this is another thing I really like to look at. Asking rates are the average advertised rates in the market. So don't worry too much about this number. We're going to more look at the relationship between the years here, because we're looking at all kinds of bedroom counts and all kinds of different areas. So the specific number doesn't matter too much. But where occupancy shows us like the demand, it shows us what the consumer is actually buying. Asking rates show us what the market is kind of expecting, or how the market is reacting at a given time to the demand environment. So, we'll kind of skip forward on this like past stuff, but pretty stable in general. Like most of the market has rates fairly in line with last year by the time the year ends, or by the time the month ends, right? So that makes sense. In some cases, they've dipped a little bit under, probably not as much as you might have seen the drop. Like this here is probably the market not reacting very well at the market level to the fact that there's a huge occupancy shortfall in March. But the same with May, not really reacting well to the fact that there's a huge occupancy shortfall. You can see that rates were pushed a little in April, so maybe over expecting Easter still, even though that, April turned out okay. And when we look forward, you see that July is dropping a little bit, but August is kind of even at the market level, and then it starts to raise in September on. So this is that kind of trend I see when you look at kind of a broader market that's pretty consistent, is many actors in the market aren't really optimizing their rate past 60, 30, 60, sometimes 90 days. In this case, it's really like 60. And you see those premiums start to appear. I think a lot of that is a bandwidth issue, particularly VRBOs and smaller property managers. You just don't have the bandwidth to really, really be optimized this far out. And what that means is you potentially start to see those pacing issues where September we probably should be in the window. That's where we see our biggest gap in occupancy pace. But the market at large is still holding a little bit of a premium there, right? And that's probably where you're seeing that mismatch. What some property managers have called the missing middle is like consumers may be looking a little further out than it seems, but the market actually isn't optimizing its price to where the consumer actually wants to pay. They haven't been able to have those conversations with the owners yet, or they just haven't been able to look at it, right? Because a lot of people are probably thinking like, hey, I got to finish out July. I've maybe made some adjustments for August. That's as much time as I had to do revenue management this week. But you see that start to crawl up as we get further and further out. And I think the best opportunity, kind of what Corey was mentioning, is if you're looking out into this place, you may be pacing on track. You can actually set goals to pace ahead, and you're kind of aware of where your radar is in relation to your historicals. Now, one thing I would say when you do the rate side is don't just look at how your ADR is pacing to where you were at this same time last year. Look at how it paced against the average, and definitely also understand like where you're going to go at the bottom. Because, you know, if you think about it like a distribution chart, so you have like a lead time distribution chart here. And I'm going to draw a line on it. We'll pretend this is ADR. If we're anything you have here that has sold that you can sell out here at like just a higher rate than this is usually a net win. Now, for an individual unit, it might not be. If they always sell up here, then obviously you don't want to undersell that. But finding the properties, especially if there's consistent properties that sell at a lower rate at the last minute, those are the ones that you can experiment with a lower rate further out. Because one, you don't have a lot to lose because their historicals aren't as good. Two, if you see that they're booking, it gives you data points and tells you like, okay, there are consumers. I just have to choose if I want to sell out there, right? Now, the hard part is when they don't sell also, and then you're not getting any data points and you're like, oh, well, that's stressful, right? Like if they don't sell, you don't get the data points and the rate is lower. That's a different story. But it does seem like it is possible for that to be there. Now, the other thing I like to show you here that I think is kind of interesting is this is the market at large. Let's take a look at what this looks like in just the top performing listings. So these are the top 20 percentile of listings by revenue over the last year. So the listings that have had a history of performing the best over the last year, how are they pricing in the market? And you can see it's quite a bit different. This is where you see that kind of like, you know, the market share of top performers is much stronger. Probably a lot of these are professionally managed. And the big thing that sticks out to me is there's a much more conservative rate position, right? The average rate position is also higher, but they've come down under their historicals pretty much across the summer, right? They are already dipping under what they were kind of posting at last year as far as September, and they're even in October, November. So the trend that you're seeing here is these top performers are revenue managing almost 2 seasons out compared to 30 or 60 days. They're looking out significantly farther and making tweaks to what they're doing to maintain their occupancy pace. They don't really start to see those kind of like premiums until we get to the end of the year, right? And my guess is if I had 2026 out here, they have, you know, pre-premium rate further out. But it's almost twice. They're basically looking out twice as far and making adjustments to what they're doing. Now, if we go back to the occupancy position here with the high performers, they're still experiencing pretty similar trends, but some of these are better, right? Like this spring trend is a little better. June looks a little better. the relationship to September to October is pretty interesting to me. When we were looking at the market at large, they were almost even. So October was really picking up similar to September. They're the highest performing listings are driving a lot more in September. September is, 50% ahead of October. And both of these are still higher than kind of like the average across the market. So there is some they're being rewarded by looking out this far and making these adjustments. And there's also like when you look at that, they're making a bet because at the end of the day, they are offering lower rates. They're making a bet that like, hey, if things are worse, I'm already going to have stuff on the books. The downside is if things end up magically getting like much better, they will have already sold a bunch of inventory, so they won't be able to optimize that ADR. But they're saying, I'm going to prioritize the occupancy first before I prioritize the ADR. And I think that's a pretty consistent approach to strategy when occupancy is under pressure in a market.
Do you think that's a good idea the rest of the year? I mean, that's essentially a strategy that we took, year to date, which was different than last year. So, we were much more aggressive last year, year to date. And this year we were less aggressive. I mean, kind of like you're saying, we're right in line with that. We were like, okay, we're going to prioritize occupancy a little, not too much. Honestly, we didn't make any like drastic changes, but we weren't, taking as big of risks as we did last year and maybe seeing as big of wins. And so kind of now we're looking towards the end of the year and like, okay, how do we feel about that?
Yeah. I would probably, so my advice as a revenue manager looking at this and looking at other markets that have been under pressure, I would make sure you're looking at October now, like on a weekly basis, pretty much. And I would set the goal to at least be pacing on track with your occupancy last year, if not a little bit more. And then you turn the lever of ADR to do that, right? If that means you have to cut rate to do that, do that. I think that my concern right now is that the tariff stuff is back in the news. And if it stays in the news, I think that'll interrupt early booking. And it's not a good time for early booking to be interrupted because this season for booking is going to be like coming up next month as like a primary season, especially for like larger homes. And if that sticks in the news, I think it'll really interrupt the sales. And so I would prioritize making sure that occupancy pace is there, maybe even being a little ahead. So too long didn't read as yes. I think you should continue to prioritize occupancy probably through the end of the year until we see a few months that, indicate the opposite. What do you guys think on that?
I agree.
Yeah, it's I'm trying to think of like what I'm seeing in other markets. There's an interesting trend that I'm not quite seeing here, but some of the markets in like the Panhandle and across the Gulf that had really bad springs, like a lot of concern over the spring, they've had really, really strong pacing for the fall. Now, they don't have quite as big of a like their seasonality is different. They don't really have a high season in the fall the same way. They expect a lot more out of the spring, which is ironic because I actually think you guys have a stronger spring in general. And I think part of why, like this has been happening for a couple of years, where like fall performance keeps surprising people across the Gulf. And I think it's just because they have lower expectations for it. So they don't like overprice it. And then the booking windows end up being pretty strong. I don't think that the consumer trend is really like the majority of the trend for shorter booking windows is coming from people's behavior just changing. I think that's some of it. Like I definitely don't plan as far in advance, but I don't think people like to plan travel a week in advance, which is where we see these big booking windows. I think a lot of it is more driven by budget. I would be more concerned with the trend that stays are getting shorter. That's the one to really think about. Have you guys like one, are you seeing length of stays getting shorter? And what are you guys doing from your restriction controls perspective? Like, what are your general length of stay restrictions? How are you changing those? Is that something that you guys have taken into account?
We have, but our length of stay has stayed pretty consistent. It hasn't changed too
What do you keep yours at, roughly?
much. 3. I mean, we have obviously we've had to accommodate weekend stays, a lot more weekend stays. So we did have minimum stays and kind of adjusted that and now allow the 2-day stays, but we're probably around between 3 and 4.
That makes sense. So you're also not pushing too hard on that.
Correct.
And like you're already not keeping it very restrictive. That makes
Correct.
sense. Jordan, I saw you come off mute for a second. Or Jack, go ahead.
Yeah.
Go ahead.
I think like the length of stay, it just varies so much because we have like a lot of unique unit types in our market too. So like a smaller cabin and a condo and a huge cabin and a huge cabin that's old and a huge cabin that's new. Like all of those are going to have different length of stays and minimums that you want to set up for them probably. But I think like as we've gotten further along post COVID, we've been more open and pushing more with owners to have less restrictions imposed from them on length of stay and to kind of incorporate that into the revenue management um, like experience. It's not just rate management, it's also allowing for shorter stays or allowing for more creative things in the future and last minute and with orphan stays and things like that. So I think that's just something we've had to really push because it's been so anti, like even other markets, like most investors here that you work with who have a decent property, they already have properties in beach markets or something, and it's just a very different strategy or length of stay than they're used to, and so it's just can be difficult conversations.
100%. Jack, did you want to say something too?
No, I was just going to follow up. I mean, yeah, our length of stay year over year is essentially the same. I would agree with I forgot who brought that up, Richard maybe, but it hasn't really changed too much. If it has changed at all, it's been we've added a different property types. That's what's maybe changed it for higher or lower. But from what we've seen, it hasn't really shifted that much.
Yeah, that makes sense to me. I mean, I think a lot of this market hasn't ever had the really long length of stays. What's interesting is obviously across the panhandle, they've basically, their length of stay restriction position has degraded completely over the last few years, where the standard length of stay from a professional operator is usually 3, unless you're in a really big home. It's just starting this year to degrade across like the Carolinas and stuff like that. A lot of them are still holding those like 7-night length of stays, but that is falling apart this year as the consumer basically is not buying the 7 nights the same way. I think you guys have always had a little shorter one, a lot of drive-in, a little more used to that. But if you do have length of stay restrictions that are greater, I think one of the things to just consider is it's not necessarily that you always have to offer that length of stay, but it follows the same trend, right? Is it adjusting for far enough in the future to kind of accommodate for that? And then I think the big one was, how do you get people to actually book those stays if they've already booked, right? If do you have a reset, like an upsell opportunity, and do you have that at a few different touch points so that you can try to get people to come and stay that extra night, even if they booked a shorter stay originally? And those touch points, usually being like when they book the reservation, if they're a drive-in guest and that they're driving in around the time that they're actually in their stay, they might be able to add them. Because you can see here that this popped up when we were looking at the spring. Definitely some different stay length stuff around these peaks. And so this would be something to kind of watch for when we get into the fall. right, is as October is coming together, are we seeing differences in this occupancy position around like, hey, you know, people are just coming for the weekends instead of this week, right? If we look into October here, it's a little early, so we're not quite seeing, but let's see. Let me draw this out a little bit.
I was actually going to add as well. I mean, one thing that we did get year over year more aggressive on, or I guess more lenient or loose on what we do for length of stay, just around like, you know, whatever rule sets or anything there. But we also haven't seen it change. So that's what's kind of an interesting is like, you know, just because we've allowed it, maybe it, I mean, I think it's helping. I think we're showing more to more guests who are looking for maybe certain dates, and maybe they're booking our cabin for an extra date than they normally would have or something, just because it's showing up. But yeah, even making that change, we really haven't seen it reflected in the booking length of stay, even if we're advertising a more aggressive one.
That's interesting. Yeah, I've heard that from people too, and I think it does have to do with the way like OTAs and consumers are searching, which is if you don't show a 3 night or a 2 night length of stay, you don't show up to the consumer. But a consumer can very easily look for a 2 or 3 night length of stay and then buy 4, you know, or look for 2 and buy 3. And so that's partly where like, you know, any kind of dynamic pricing is usually stacking revenue into the highest demand dates so that if you do have a lower length of stay, you know, people who do buy the lower length of stay, you don't give up a bunch of revenue, but also, you know, it makes those competitive around it. So if they're like, hey, you know, adding 1 night ends up only adding 10% to the stay instead of 30%, people sometimes make that, right? Now this is the place I think to watch, right? We're a little early to see that in October right now. But last year, these weekday occupancies were quite a bit higher. I mean, these weekday occupancies in October were almost as high as the weekend occupancies in September last year. And so, really just monitoring how that's coming together this year. I think if you're able to kind of see this come together in late August, in particular by late August, you might be able to make changes to really drive that if this trend starts to be different. Because we did see that it was quite a bit different in March, right? Um, Okay. One other thing I wanted to look at is I am going to pull up this lead time distribution chart for October 2024 or 2020. I'm on future. I want historical. Sorry. Um, lead time October last year, 2024. Just to kind of see, uh, we're looking at everything right now. I like to get an idea of where a few data points are for lead time, and you can do this with your own portfolio data. Honestly, you probably want to do it according to your like bedroom count groups because those lead times tend to be shifting further out the larger your unit is or the nicer your unit is. But to me, it gives me an idea of like really when game time is. So if I'm looking at this lead time distribution chart, there's a few data points that I like to look for. One is 50%. So roughly 50%, that means like half of the reservations are on the books in the market and half are yet to be booked. And in this market in October, it's pretty far out. It's 50 to 55 days. And what I mean far out is it's pretty far out considering that like that's all bedroom types, right? Often if you go down to the Panhandle, there's a lot of condos. That's like sometimes less than 30 days, right? They're making half of their reservations within the month. But this median, you know, people talk about like either the median or the average booking window. This data point for me is not a data point to tell you when to start looking. This is like you better be on your pacing goal. If you're not, it's like a code red, right? Because this is like the prime booking window, right? Um, you can see how much occupancy is being put on in the weeks around this. It's a lot of reservations. And so this is kind of like this 50% mark is like, hey, I've got to be I've got to be meeting my goals by this point. Where I like to look to start is around that 80% or 90%. So finding a data point where it's like, when should I really start paying attention to this on a regular basis, right? To make sure that I'm going to hit that pacing goal that I have for myself, whether that's to be on pace similar to last year, be a little ahead. Maybe if you're, you know, things are really good, you might say I'm okay with being a little behind. But that 80% I think is a pretty good point to say, 20% of reservations for the month are on the books already. 80% are yet to be made, but you can see from that point, it's just picking up more and more every week, right? So we should see a growing, increasing trend in pickup. And here it's about 90 days. So 3 months out from maybe the end of the month. So October, September, August. That means it's about next week is like when you really should be looking at October on a weekly basis. Some people will push this out a little bit. So if you go to the 90, it pushes out about 30 days. So you can see that that's a lot slower, right? It's a whole 30 days for just 10% more on the books. And I think whenever you have a high season, just finding those points for your different groups of your portfolio are good and just throw them on your calendar. Like tell your team, hey, this is when we need to start paying attention to this month because that's how we're going to make sure that we can make small changes and minor adjustments to meet our goal rather than getting stuck in this like last 20%, which is 25 to 30 days and trying to kind of compete with anyone else who's vacant, especially if the market's under pressure, right? That's where like pricing starts to collapse, in my opinion, is when we get into this last 20% because people are just prioritizing getting any occupancy they can and not being vacant. If we shift this larger, so we do 4-bedroom plus, we can see that this will probably shift out quite a bit. So it's at about 110 days. Is that 20% instead of 90? So about 20 days further. And then that 50% is at about 60. So interestingly, the 50% is around the same place, but that early booking window shifts out. You can see that this curve is much more gradual and much further out. That 10%, let's find where that is. I mean, that's almost at 140, right? So quite a bit further out. Like honestly, if you have really big homes, what you're paying attention to is probably like started in July or end of June. Awesome, guys. Well, really appreciate your time. One quick thing, just a reminder, all of these market reports are free. So if you ever need to kind of access this data or you wanted to go look up your different lead time stuff for different months, you can. Additionally, these charts here around occupancy and asking rate, which I think the occupancy one in particular is really good to talk to owners with, just because, this is a readable chart for many people. Not only can you access this, but you can export it as a picture pretty easily. So those are available for anyone. If you just have a Wheelhouse account, you don't have to be a Wheelhouse pricing customer. In addition to that, I talked a lot about pace and like comparing what's going on in the market to your own pace, because that's kind of what the strategy is, right? Like if you're ahead and the market's behind, that's going to be different than if the market's ahead and you're behind. If you don't have tools to easily see your pace across different groups of listings, Wheelhouse does have a free business intelligence tool that will do so. Basically, we'll show you all the way down to a daily level how you're picking up, what your pace is. We can compare it to last year. You can also compare it to market data if you're using some of our different, more granular market data tools. And this is also free. All you have to do is sign up, get access to what's going on. You can see how things are picking up. It'll show you what's on the books, what your sales are, and where you were compared to last year. And you can do that and slice and dice that for any group of listings, right? You can look by market, you can look by submarket, you can look at just your bedroom counts, you can make custom groups. It's a pretty cool tool. It's very accessible for quick, I need to check pace on a weekly basis and just make sure I'm where I'm at. And we do provide training on how to use it if that's something you're interested in. So let us know if you'd like access to that, or sign up and experiment yourself. And otherwise, if you think of any questions, let me know. And I hope you guys found this helpful today.
Thanks, John.
Awesome. Appreciate your time, guys. I'll send you guys the recording. And then, look out for this. We'll probably do another one in Sevier County in the fall, kind of see how things go, round it up for, preparing for next year.
Cool. Thank you.
Awesome.
Okay.
Thanks, John. See you, everybody.